Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
South Africa, similar vein. If you look at the South African currency, it's been one of the best emerging market currencies in the world. Now, why should that be? Optimism over commodities. It's a commodity currency. But if you look at what's going on in South Africa, their economy is still crumbling underneath their feet. And we believe the political risk is rising dramatically now with Zuma in office, and the ANC seems like they're consolidating more and more power. So we think there's huge political risk, and also the ANC has to deliver in a very big way. They made a lot of promises during this last election that we're not sure they can fulfill, and some people are very unhappy, and even some ANC supporters are becoming unhappy. But needless to say, you got political risk, and you still have the economy just cratering in the background, yet the South African rand has soared against the U.S. dollar over the last few months. So these are the I think we're seeing some of this carry being played out here on this optimism over China. And as Steve and I were talking about earlier, we just don't think this makes sense because of the fact that some of these countries may be doing okay now, and they're getting some liquidity surges back in. But these countries in general are not drivers of global demand. And if we throw China on here, it doesn't matter. China, if we add up the global demand driven by these countries, it's just not there. These are major, primarily export countries that people are pouring into. So we still need, from a risk standpoint, need to see the U.S. recover, the Europe recover, or Japan recover, three of the major economies in the world, to really make sense of some of these moves. So, again, just want to make that point that, you can say, wow, the Australian dollar has really cratered, lost like half its interest rates. Well, it's still the big dog on the block from an interest rate standpoint, and we think that's one of the reasons why we're seeing such a big move in the Australian dollar. The Australian dollar, as we've talked about before, is the key risk currency among the major currencies. It tends to do very, very well when global growth or optimism is in play. It does very, very well when people are optimistic about China because they know China is going to demand commodities. And Australia literally, during the last cycle, could not dig the stuff up fast enough and ship it to China. So this is another reason, even though they have been cut in half relative to these other currencies, it's still a great play to borrow in low-yielding currency and reinvest in Australia on global growth, and that's been part of the boom we've seen here. And that opportunity may continue. So what are the three assumptions behind the carry trade? Okay, these are the assumptions, and I think this is where, if you understand these, you understand that some of the risk here, and you understand that these aren't always just one-off opportunities. You borrow the low currency, you reinvest in the higher one. These things have to be in place at least from a standpoint to give you some confidence that the trade will make sense over any type of time frame that makes sense for you. Needless to say, low borrowing rates in the currency you're going to use to fund, but also low volatility or weakness in the funding currency. If you're borrowing a low-yielding currency, if it's highly volatile and you don't know what it's going to do, and you're not confident that it's going to stay within a range, or it's going to show relative weakness against whatever you're investing in, then it doesn't make sense to make this trade regardless of how low the yield is. Let me say that another way. What happens is, just because you have a certain yield spread, meaning you borrow at 1% and reinvest at 8%, that's great. You have a 7% yield spread. But currency movements, if they move the wrong way, can eat up that yield spread very, very quickly, especially if you use leverage in that. They can eat away very, very quickly. So the requirement is not just low borrowing rates, but you have to have some low volatility in the currency you're borrowing, or some trend in weakness relative. You can have some volatility, but a longer-term trend in weakness relative to the asset class you're reinvesting in. Also, you prefer low volatility minimum or strength in the invested asset class where you're using the proceeds. You're borrowing here, investing here. If this doesn't weaken where you're borrowing this currency but just stays within a range, you're fine. You're fine. And you reinvest here, you got the yield differential, and you have, if this strengthens against this ranging currency, you have yield differential, plus you have the capital appreciation, which we talked about, and that's what most people are looking for when they make a carry trade. Often they're only looking for the yield, but often they're looking for both, and they've gotten both in this cycle. So you get a double whammy here when you get these set up. Now, say you have this condition in place. Number one's okay. Let me erase this right here so you can see my fancy check marks. Second, too much writing today. Sorry about that. So you have number one makes sense, number two makes sense, but if number three doesn't make sense, if the asset class you're going to reinvest these proceeds in is highly volatile, or if it looks like it's weakening or turning over, this does not matter. You know, you're going to lose money, even though it looks like you have a very good setup here. All three of these criteria need to make sense going in, or at least your assumptions of these criteria making sense. We're never going to know. We're never going to know if things are going to stay low volatility. We're never going to know if things turn strong or weak, but we have trends to go from in the past. This is the assumptions that are made in the carry trade, and these were the assumptions that were made in a very, very big way by those hedge funds that did a lot of this carry trade. What assumptions went wrong? Well, this one went wrong. Low volatility as far as the eye can see in the funding currencies because the yields actually fell, and also low volatility and strength in the investment classes. The credit crunch changed that in a very, very big way. So let's take a look at that. All right. Here's an example of, you know, kind of what was going on in the world. Really, 2001 is when really this stuff started blasting off back here. I'm looking at 2003 up until credit crunch time frame. It really started in late 2007, but some of the markets didn't break till in 2008. But if you were borrowing Japanese yen, right here, you had the criteria, you were borrowing Japanese yen. The Japanese yen was still relatively weak and from really relatively low volatile, but generally weakening against the other currencies because it was being borrowed so much. And you had the other asset classes really going straight up. Not only did you have fairly low volatility in these other asset classes going up, commodities, emerging market stocks, stocks in general, you know, and I think Steve will point this out, and we had an incredible low volatility moves in some of these things that were just so highly correlated, tick for tick, up, 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 up. You're borrowing a low rate currency, you're getting weakness in the yen or relative weakness in the yen or Swiss franc, and the rest of the asset classes, you could have put real estate on here doing the same thing. You're basically throwing a dart. So you're saying to yourself, yikes, this is easy. And that's what the hedge fund said to themselves, and a lot of the hedge fund traders that didn't have gray hair said that to themselves, that, hey, this is a very easy trade. So that led to more and more borrowing, and it led to this self-reinforcing moves, and that's why we had over, you know, $1 trillion plus in yen borrowings, because this game got so easy, so easy, so easy, and it all changed because of the credit crunch. So that's why it happened. You had all three of these criteria in place, and now the game has changed a bit.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.